JPMorgan and Citigroup kicked off bank earnings season on Tuesday. Both did better than expected, but they're heading in very different directions. So how are the banks doing? Well, the first thing to note is that they put aside less this quarter to protect themselves from bad loans than they did between March and June. JPMorgan and Citi last quarter put aside a combined $18 billion against bad lending. This quarter is down to $3 billion. So in short, they think they're in decent shape based on how their customers are doing. For example, almost all of JPMorgan's borrowers who had asked for deferred payments on their credit cards are now back on track. So that's got to be a good thing for the economy and for the lenders themselves. But being a big bank just isn't as much fun as it used to be. Interest rates are low and they're staying that way, and that's what dictates the lion's share of banks' income. Trading stocks and bonds is still a money spinner because banks make money when markets are volatile, but that can't be relied on for very long. And the presidential election that's coming up in November could bring a chill wind blowing through Wall Street if Democrats land the White House and a dominant position in Congress. But not all banks are in the same state. Citigroup's shares have fallen almost 3 times as hard as JPMorgan's in the last year. There are a bunch of reasons for that, but one is that Citi keeps getting wrapped on the knuckles by watchdogs who say its internal controls and processes just aren't up to scratch. Bad behaviour really is a way of life for some of these institutions, but Citi genuinely is on probation. It's got a new boss, Jane Fraser, who takes charge in February, and that's going to give the bank a fresh face. But let's face it, investors still have their eye on those same old problems.